Good afternoon, and today is Wednesday, June 8th. Live from Washington, D.C., Venable LLP welcomes you to our webinar, Election Year Political Activity, a primer for financial services providers. My name is Jonathan Pompan, and I will be the moderator for today's webinar. I'm a partner and the co-chair of the Consumer Financial Protection Bureau Task Force here at Venable. The 2016 election cycle is in full swing, and major changes to the financial services regulatory landscape, including the Dodd-Frank Act and the Consumer Financial Protection Bureau, could turn on the outcome of the election. From the boardroom to the call center floor, government relations staff, CEOs, trade associations, everyone this year seemingly wants to get involved in the political process and to do so in a way that avoids legal and regulatory traps while exercising their First Amendment right to free speech. And even as the field of candidates narrows and the legislative proposals are unveiled, the plans that companies have and individuals may have to get involved in the political process are still evolving, and they're continually changing. There's not a day that doesn't go by where there's announcements in the press of companies getting interested in being involved in the election process, or others perhaps rethinking their plans. So to help get everyone up to speed, we have two fabulous guests that have joined us today for our conversation. My friends and partners, Ron Jacobs and Larry Norton, both co-chairs of Venable's Political Law Practice Group, will join us in just a moment, but first, some housekeeping. Our webinar today is going to be recorded and downloadable after today's session. The slides are also going to be available after today's session via email to those that are participating today. Please follow the on-screen prompts for submitting questions. We'll do our best to incorporate them into our discussion and we'll remind you periodically of the opportunity to ask questions of our all-star panelists. Of course, contacting us and asking any questions doesn't create an attorney-client relationship, and the opinions expressed today are those of the individuals, not Venable, or any of their clients. So please don't send confidential information to us in those questions. Now, there's also CLE today, and so for those that are on and are going to be receiving CLE credit and submitting for that, we will provide a code at the end of today's session. Information about the certificate will also be sent out via email after today's session, likely either this afternoon or tomorrow. So whether your company wants to play a role in the election or your executives are personally supporting candidates, it's important to understand the rules, have a compliance plan, and be able to execute. And while those in politics often say there's only one day that really matters, Election Day, it turns out that being compliant is a full-time, 24 hours a day, 7 days a week job for anybody involved in the election process or political activity generally. It certainly can have compliance impact as well as also reputational impact. So now let's meet our all-star panelists and get into today's session. So we're joined by Ron Jacobs and Larry Norton. Ron, welcome.
Thanks, Jonathan.
And Larry?
Thanks, Jonathan. Let me kick off with our agenda for today. We're going to cover a lot of territory at a kind of high-level view, focusing on election activity, but drilling down a bit to some areas that we think are of particular interest to companies in the financial space and to corporations generally. I want to do a bit of an overview on campaign finance rules, speak particularly to the so-called pay-to-play laws that are aimed at institutions, firms, companies that do business with state and local governments and to some degree the federal government. We've got an overview on PACs and super PACs, and then we want to wrap up with how these rules really work in practical application for holding fundraisers, for inviting officials onto the business premises to meet with executives, and even to support the upcoming July conventions.
Ron, before we get started, difference between political activity and campaign activity. Today we're talking about everything, is that right?
Yeah, we're going to focus on campaign activity as opposed to lobbying. Lobbying would be where you're talking, interacting with government officials, trying to get policies achieved. Here today we're really talking about fundraisers, interacting with candidates, supporting candidates or opposing candidates, and those kind of activities.
The question I think people ask themselves all the time is, should I get involved? Why should I worry about elections and political activity. We've got an awful lot of other things to deal with on our plate. And I think the answer to that is that there really are few, if any, companies that can afford to stay entirely on the sidelines during elections or the aftermath of elections for obvious reasons. And that's because the people who are getting elected are involved in decisions that will protect your business, will help you make your business more competitive, that may create significant opportunities or deprive you of opportunities. These are the people who really will be making key decisions and appointing others to make decisions about the regulatory climate. As with any kind of regulatory activity, with opportunity comes risk. And as you'll hear over and over again through our presentation, the laws that regulate political activity vary widely from federal to state and then across the states and localities. One of the important points that we want to emphasize today is that these laws, while they're aimed largely at businesses and the conduct of business activity, can simultaneously affect both the business and the individuals who are politically active. And so for obvious reasons, compliance really has to bring the company together. It needs to bring those who are in government affairs together with those who are in compliance and any senior executives or others who have regular contact with government officials. The important thing to remember here is that there are lots of eyes on what you're doing. There's scrutiny from regulators, lots of political activity, campaign contributions are reported by the recipient committees and can be searched online by your competitors and by others. The media is, as you know, very interested in election-related activity. There are watchdog groups devoted to nothing but scrutinizing election activity. We often tell people that there's a public relations impact to anything that you do in this space. In fact, even those of you who file lobbying reports ought to look at that document not just as a disclosure document, but as a public relations tool. The key really is to manage your risks, and there are a few points that we'd emphasize and we'll come back to in the end in an effective compliance program. Most importantly, that you have simple and clear policies and procedures. We recommend that you provide regular training for those who engage in interactions with government officials, which should be at least once a year, in particular for companies that deal at the state level where the laws change much more frequently. Employees need to know who is responsible within the company for answering questions about fundraising activity and other kinds of interactions with government officials. And to the degree possible, you want to separate responsibility for compliance from the government relations side that's actually engaged with office holders and the compliance side that is ensuring that everything is done the right way.
So as we go through today, we'll be talking about a lot of different, each activity is subject to regulation in a few different areas. So there's, first of all, the campaign finance law rules at the federal and state level, depending on whether you're giving federal or state candidates. Then there are the pay-to-play rules that come into play. There are some federal rules that apply to certain folks who are regulated by the SEC or the Municipal Securities Rulemaking Board. And then there are state pay-to-play laws that sit in on top. And so we want to make sure anytime we're talking about different political activity that you think about each of these buckets and how they might apply to what you're doing. So let's start with the campaign finance laws. And the way we'll do it is we'll go through sort of an overview of the campaign finance laws and then drill down a little more specifically on certain things to do. So we'll start with the federal campaign finance law. And can I talk about the basics? There are kind of 5 key points here to keep in mind. One is that federal law distinguishes between contributions and expenditures. And we're going to talk about that a little bit more in a second. Federal law imposes limits on how much individuals may contribute to candidates and political committees. It places restrictions or prohibitions on contributions from certain kinds of entities or people. It requires broad disclosure of donors. And one of the key ones that we find people miss all the time, even though it's a fairly simple black letter law, is that donors may not be reimbursed for their contributions. You can't use straw donors. So if Larry wants to make a contribution to a candidate, he can make a contribution to a candidate. If I want to make a contribution to a candidate, I can make a contribution to a candidate. But Larry can't make a contribution and then have me reimburse him for it. That's absolutely prohibited. A lot of companies and executives get in trouble for that every election cycle and face criminal penalties for that. So it's an important element to keep in mind. So as I said, the campaign finance law is distinguished between contributions and expenditures. And this is important because a lot of the restrictions we're going to hear about are on restrictions on contributions as opposed to expenditures. And so contributions are basically things you give directly to a candidate, whether it's money or in-kind services, where expenditures are things that you do on your own. So when you're talking about contribution limits, the rules are that an individual can give up to $2,700 per election to a candidate. A lot of people are always surprised by how low that number is, but that's the limit. It's $2,700 for the primary and $2,700 for the general. There are two kinds of PACs that we'll talk about today, multi-candidate PACs and non-multi-candidate PACs. Multi-candidate PAC, which is what most well-established PACs are, allowed to give $5,000 per year per election, and non-multi-candidate PACs are $2,700 per year. What's interesting is that individual limits are indexed to inflation, so those go up every 2 years, whereas the PAC limit stays the same. There are other limits that to give to the national party committees like the RNC and the DNC, and then the federal accounts of state and local political parties as well. Since we're talking about financial institutions and financial services organizations, there's an important prohibition in the Federal Election Campaign Act. National banks are prohibited from making contributions and expenditures for any election of political office. So this is federal, state, or local political office. So as we go through and talk about state campaign contributions, for example, a national bank is not allowed to make those contributions to state candidates. They are allowed to support ballot measure committees, and other parts of the bank are allowed to make those corporate contributions. It's really the national bank itself that's prohibited. And it does allow even banks that are national banks that are subject to the prohibition to form political action committees at the federal or state level.
And Ron, would that apply to individuals at the bank or just the bank itself?
This applies to the bank itself.
Are there other industries where there's limitations on individual giving?
Yeah, there are, and we'll talk about sort of the pay-to-play rules and how those apply on individuals in a few minutes. Foreign nationals are also prohibited from giving to candidates at the federal, state, or local level, and this prohibition is even broader and applies to ballot measures. So if you're in a state where there's a ballot measure on being voted on, foreign nationals are not allowed to make contributions there. They're not allowed. Foreign nationals are not allowed to make giving decisions or have control of a PAC. So if you form the political action committee and have a foreign national on in the company, they're not allowed to be on the PAC committee to make those decisions. And a foreign national is defined as someone who's not a U.S. citizen or a permanent resident alien or a green card holder when you're talking about individuals. Foreign nationals are allowed to volunteer for candidates as long as they're not soliciting contributions. The next big prohibition is on corporate contributions. Corporations are not allowed to make contributions to candidates, PACs, or political parties at the federal level. Now, everyone always says, well, what about Citizens United? I thought that was a big Supreme Court case that said that corporations are allowed to make contributions. And the answer is that that's not exactly the case. And as I mentioned before, contributions and expenditures are two different things under the federal election law. Contributions by corporations are still prohibited. But independent expenditures, where companies spend their own money to air commercials to support or oppose candidates, or give to independent expenditure-only type committees, those are permissible, but making contributions to candidates is still impermissible. Now, what we've found is that very few corporations actually make independent expenditures, even though they're allowed to. Generally, it's more individuals that fund those sorts of efforts. The ban on corporate contributions also prohibits using corporate resources for fundraising unless you're doing it in certain particular ways, which we'll talk about in a little while, to particularly the restricted class. And again, the company is not allowed to reimburse employee contributions. Corporate facilitation is a subset of corporate contributions. Basically, you're not allowed to use your corporate resources to raise money for candidates. The SEC has brought enforcement actions in this area, even with an agency that is often known for not enforcing the law very rigorously. In certain areas, in recent times, they have still been bringing actions for corporate facilitation. So anytime you're using subordinates to conduct your fundraising activity, paying the costs of events, or collecting contributions, those are all examples of facilitating contributions using corporate resources. So an area in particular where we get a lot of questions are senior executives who want to engage in personal fundraising activity for candidates will often have their personal assistants try and get involved in the fundraising process. And even though those are people who handle everything for those executives, from their schedule, to their dry cleaning, to whatever it may be, they're not allowed to engage in political activity for the executives unless the executives pay for that staff time.
And that could include helping plan the event, being the primary point of contact for RSVPs, things, again, that seem kind of innocuous or may seem innocuous given the range of activities that the assistant may be involved in.
Exactly. So that's our tour of an overview of the federal law. Now we'll talk about the state law that applies.
Well, we hear all the time from clients that they wish there was some consistency between the federal and state laws and among the states, and unfortunately there's not and unlikely to be anytime soon. As I mentioned, the laws vary significantly from state to state, but here are really some of the basics. Most states regulate contributions in some fashion to state candidates. There are a handful of states that apply no limits at all, and others will apply limits only to corporations or individuals. Again, something to look at carefully. State law often governs local elections in that state, but not always. In quite a number of states, major municipalities and counties will have their own campaign finance rules. There is separation, though, between the state and the federal law, and so state laws that regulate campaign finance do not apply to federal candidates or even to state officials who are running for federal office. And this is a snapshot of the law right now in terms of direct corporate contributions to candidates. And so in those states where corporate contributions are permitted, that means that the company, the firm, doesn't need to form a PAC, that the law permits a corporate entity to use treasury funds to make direct contributions, and may be subject to limits, but make direct contributions to candidates, PACs, political parties, or some combination of them. There are other state law considerations to bear in mind that don't apply in the case of contributions to federal candidates or to the national parties. A number of states restrict contributions while the legislature is in session. And some states even restrict contributions before an election cycle starts. There are states that restrict contributions by lobbyists, and just a few states, Maryland being one, where lobbyists cannot even be involved in transmitting a fundraising solicitation that they receive from a candidate to their corporate or trade association employer. Disclosure varies widely. There are a number of states that actually require corporate contributors to file a separate disclosure form, even though the disclosure contained in that form is duplicated by the recipient committee. Very important to pay attention to aggregation rules, rules that govern whether multiple corporate entities or multiple business entities are subject to a single limit or are entitled to make separate contributions up to whatever the maximum limit might be.
So now we've sort of given you the quick tour of the different campaign finance rules. And again, these are at the federal level for federal candidates, state level for state candidates. Now there's an overlay that comes into play of these pay-to-play rules. And the pay-to-play rules are rules that apply to those who do business with the government. So if you are a financial institution that has manages money for a state, or if you do bond work for bond offerings for municipalities, if you have other contracts with the state, there are a variety of different pay-to-play rules that apply. The idea is that the organization or individuals associated with the organization don't make political contributions, the paying, in order to get the government contract, the playing. And so what's interesting about these pay-to-play rules is we'll drill down on, is that they apply not only to the organizations, the companies involved, but also to certain individuals, employees, officers, owners. It varies depending on which set of pay-to-play rules apply. And so typically, individuals are allowed to make contributions on their own without a problem. But in this pay-to-play space, personal political activity by individuals actually gets swept up into the company. And so in certain cases, you may actually not be allowed to, an executive at a company may not be allowed to make a contribution for the company to comply with the pay-to-play rules that affect the contract. Keep in mind, this primarily we're dealing with state contracts. Even though there's some federal agencies that have regulation in this area, it still generally applies to state contracts, which means it applies to state candidates, so that at the state level that these rules really come into play. So let's talk about, there's sort of two primary federal pay-to-play rules that come into play. The first is for the Securities Exchange Commission rule for investment advisors. And this rule is designed to prohibit investment advisors from receiving payments from state or local governments if certain individuals or the company makes campaign contributions. The scope of the rule here is that it applies to the company, the PAC, and also covered associates, which is a term we'll unpack and talk about in a minute. And the key is that these restrictions apply to contributions made to officials either who control the investment decisions of the state or local government, or to people who appoint those who do. And it also imposes a restriction on soliciting contributions to political parties, so that if you can't give to the state Republican Party or the state Democratic Party in an area when you may be trying to have a state government contract or a local government contract. So where does this come into play? You may be saying, well, I don't, what part of the SEC's rule applies to me? So if you are an organization that has investments of government funds, such as a hedge fund that has a state pension fund invested in it, a retirement fund, or university endowments that are for public universities, those, although you're not providing investment advisory services directly to the state, you're providing investment advisory services to the hedge fund or the private equity fund, which does have the contract with the state, and that's what the SEC says applies. It also applies if you're providing services for pooled investment vehicles. So if the state has a 529 plan that you help manage, and one or more of the options are serviced by the investment advisor, then you're subject to this the SEC's pay-to-play rule. The SEC rule says that covered associates may not give contributions to office holders, elected officials who can control the contract, the award of the contracts. And covered associates are defined as partners, managing members, executive officers of the organization. The executive officers include the president, the vice president in charge of a principal business unit, division, or function, or other officer or person who performs a policy-making function at the organization. It also applies to any employee, regardless of their title or rank in the organization, who solicits a government entity for that investment advisor. So if you have sort of someone in the sales function or the business development function who's meeting with government officials to try and get the work for your organization, then that person is also a covered associate. And then it also then goes up the chain to anyone who directly or indirectly supervises those employees. A covered associate is also defined as any PAC controlled by the registered investment advisor or a covered associate. So if you have a political action committee, you want to be careful to make sure that your covered associates are not sitting on any kind of steering committee, serving as the treasurer of that PAC, so that you're not getting, you're not subjecting that PAC to the restrictions imposed. The timeout period, the way it works is the SEC swears up and down that this is not a ban on making political contributions. Rather, they say it's a timeout on receiving compensation. So if one of your covered associates makes a contribution to an official who's subject to the rule, then you have a 2-year timeout period on receiving compensation, which includes carried interest and any other sources of fees and revenue that you might generate for performing these services. The 2-year prohibition. It also applies to new employees who are hired by the investment advisor and who are considered to be covered associates. So if a covered associate does not solicit state business, you only have to look back 6 months. But if a covered associate is hired to solicit state business, then you've got a full 2-year look back. And if that employee, if you hire a person within 18 months and they've made a contribution, or you hire a person and they've made a contribution in the past 18 months, you're not allowed to accept business from that state or local entity until the end of that 2-year cooling off period. The SEC does allow for de minimis contributions, So if a person, one of these covered associates, is allowed to vote for the candidate at issue, if it's a resident of the state of Ohio and they want to make a contribution to the candidate for governor, they can make a $350 contribution. That's regardless of the state law. So even if state law allows for a much higher contribution limit, this imposes a $350 limit if you want to have that business with the state. If the person is not allowed to vote for the candidate, then it's $150 per election limit, so a much lower threshold.
Ron, do these rules apply to folks like in advance of having the relationship with the state, or is it after, during and after too?
Right. So the timeout period applies for 2 years from the date of the contribution. So perfect some examples on sort of how this comes into play. So if you were to in a state where the governor appoints one of the state pension fund board members, and this is just an interesting situation when the governor is running for the U.S. Senate. If a covered associate contributes to the Senate campaign, then you have 2 years before you could, anytime after that contribution for 2 years before you can receive compensation. So you may have given on 18 months ago, you're starting to negotiate a contract with the state. The contract kicks in after that 18 months, then it's okay. But if it kicks in sooner, you wouldn't be allowed to receive the compensation at that point in time. And this was an example of where the governor is running for Senate. It's one of these where the rules actually sort of cross over from federal to state. So if a sitting state governor, you want to make a federal campaign contribution to the federal Senate committee, and the pay-to-play rule applies here because the FCC says that regardless of what position they're running for, it's a current office holder who has that authority to appoint a member of the investment board, so it applies in that situation. Another example might be where if the mayor appoints an investment manager for city pension fund, an individual makes a contribution on May 1st, and then that person is hired as a group vice president as an investment advisor on December 1st, you're beyond that 6 months because that person is not soliciting the government employee, so you're okay. If that person was soliciting, then you have that full 2-year look back. That's an example of where you hire an employee and it comes into play. Another set of rules that are very similar to the SEC rules, and so we spend a little bit less time talking about them, are the Municipal Securities Rulemaking Board, called Rule G37. It applies to brokers, dealers, and municipal securities dealers. And there, unlike where the SEC uses the phrase covered associate, the MSRB rule refers to municipal finance professionals, which are, again, a defined term of people who are involved in sort of the business with the state. It also includes any PACs that are controlled there. And it, too, imposes a 2-year prohibition on doing business with an issuer after contribution is made. So if you made a contribution to the mayor of a city where the mayor helps to select the underwriter for the bond offering, then you'd be subject to a 2-year prohibition before you're allowed to do that work. So again, here, keep in mind, think about the specific industries. The federal rules apply in addition to any state rules. And Larry's going to talk now about the state law pay-to-play rules. And so if you're operating in an area where you're in one of the, you're doing MSRB regulated work or SEC regulated work, you've got the federal rules. If you're in a state with these state contracts, you've got the state rules. And so then you are subject to that area in the middle where you've got to deal with both sets of rules, which may impose different limits, broader application to different kinds of employees, and you really want to be very careful about that.
So we're going to talk about state pay-to-play, which really is state and local pay-to-play, which, as Ron suggests, creates a broader net for some and a net that applies to many who won't also be subject to the SEC pay-to-play rule. The basics of a state pay-to-play law are laid out here. They generally either prohibit or they restrict contributions by entities that either are bidding on or are currently performing under a state or local contract. And the contracts, as we'll get to in a moment, are maybe described based upon the amount at issue or the type of contract, whether it's a competitive bid or no bid or that type of thing. But that's generally the idea, that there's some restriction. They may also restrict fundraising. And importantly, like the SEC rule, the contribution restrictions often apply to officers, directors, senior managers, and what has to be a really quaint sort of view of marriage to the spouses of covered individuals, assuming, I imagine, that the officer or director of the company is aware every time a spouse writes a contribution check. Some of the restrictions on pay-to-play in the state pay-to-play laws, again, like the SEC rule, actually begin prior to the submission of a bid, and in many cases they continue to be in effect for months after the contract is finally terminated. And in addition to, or instead of, in lieu of these restrictions or prohibitions, states may require companies that are bidding on or have contracts with the state government or localities to file periodic disclosure reports where the contributions made by the covered individuals, by the company, are reported and available online. Again, these are the basic types of laws. There's often a mix and match. Many laws both impose restrictions and require disclosure, while others do just one or the other. There's a lot of variation among the states that have pay-to-play laws in the kinds of contracts they cover. The idea seemed to be, when these laws first started getting passed, that what they were really after, as Ron said earlier, was a pay for a play. And so there was a certain logic in applying limits on or prohibitions on political contributions to sole source contracts or contracts that are awarded outside of the competitive bidding process. Notwithstanding that, many states have pay-to-play laws that apply to all government contracts or all government contracts over a certain amount. And I should mention that pay-to-play, unlike many other campaign finance restrictions over the last few years, have been upheld repeatedly by federal circuit courts, and is an area of the law where there really has been just an explosion of regulation over the last 5 or 10 years. Again, as I mentioned earlier, the value of contracts held or sought, the thresholds can vary as to those. So you have jurisdictions where the pay-to-play laws only apply to contracts where the total value that the contractor will receive over the life of the contract is some amount, or the amount that will be received in a particular year is a certain amount. And again, the types of contracts that are subject to pay-to-play laws can vary. For the most part, the laws apply to contracts for goods and services, but in many jurisdictions they also apply to real estate transactions. So you have a building, you lease property to a government agency, suddenly your key employees and officers and owners are subject to the pay-to-play law. There's also variation in the way the laws apply to, on the other end, not just those who are making the contribution, but those who are receiving the contribution. Again, almost all these laws are going to apply if you're talking about contributions made to public officials or individuals running for an office in a jurisdiction where you're actually bidding on the contract or have been awarded the contract. But some pay-to-play laws are much broader and reach contracts that you make anywhere in the state, even at the local level. Some jurisdictions apply the restrictions on government contractors and their employees to contributions to political parties, to PACs, to so-called leadership PACs that are often formed by elected officials. So the details can be very important in terms of teasing out the application. Pay-to-play laws almost always apply to the contracting entity and certain entities, often the subsidiary and parent entities or certain affiliates as described in the law. And although, again, there's lots of variation from one jurisdiction to another, the individuals you see listed here are typically the ones who are subject to contribution restrictions and the ones who we emphasize to our clients really need to receive some kind of ongoing training and some written notification regarding the way the laws work. The thing about pay-to-play laws, it's true of the SEC law too, is it really collapses the distinction between the business and the personal. And so it makes compliance challenging depending on your culture, where you need to say to your officers, directors, and even your senior managers and ask them to talk to their spouses about limiting their personal political contributions or pre-clearing contributions in high-risk jurisdictions because that $500 or $1,000 contribution that they write out of their own checkbook can cost the company millions of dollars in business.
In particular, I would say for larger companies, the directors are often one of the group of people that are difficult to deal with because they are not employees of the company. They meet periodically, and yet suddenly they're told, gee, you can't make a political contribution because it will cost us our government contract. And that's one where there's a lot of finesse required that I've found to sort of tell people that they can't make those contributions, or if they want to make a contribution, that they've got to talk to the legal department at the company to pre-clear the contribution. That can really be difficult when it's one thing when it's sort of a senior vice president who sits in the office, will walk to the general counsel's office and get the clearance, another for this director who's not on a day-to-day basis with the company. So you really want to make sure you've got those. If you've got these state government contracts, you've really got that plan in place to capture the work of the director or the contributions of the directors, so that you can either let them know if it's permissible, or if you have to, in some of the states where it's disclosure, it's still complicated because you need to know when and how much and to whom they made their political contributions in particular states. And again, they might not be sort of the turn it around the next day kind of thing that some of the other employees will be.
So one area where pay-to-play regulation really distinguishes itself from other campaign finance laws is that the penalties are severe and they hit at the bottom line. And so while election law agencies are often criticized for the slap on the wrist or the fine that a corporation may regard as the cost of doing business, not so here. There are a number of jurisdictions that have pay-to-play laws. New Jersey is kind of the leading edge in this area, where many contractors' bids have been disqualified and contracts voided over relatively minor contributions by corporate executives and owners. And companies have been barred from bidding on future contracts for some significant period of time. On top of the loss of contracts, state pay-to-play laws and local pay-to-play laws can involve fines and criminal penalties and can be terribly damaging to reputation. These kinds of investigations or fines are almost always picked up and reported extensively on in the media. They can even prompt criminal investigations on bribery charges. So for those who are involved in the government contract space, providing some kinds of services, goods and services for the government, very, very important to ensure that there is a compliance program in place and a risk assessment made regarding how these pay-to-play laws might affect the company.
Those examples in New Jersey, I think, are really good ones where there was one case where it was a road contractor, the head of the company, the owner, made a contribution to a state political party at the request of a friend, had nothing to do with the bid, and they lost the work for a bid that they'd otherwise competitively won. They lost the work. A law firm that was doing bond work for the state for a very long time, one of the partners made a contribution, and it violated the pay-to-play rule. They lost the work. So again, those were things that were inadvertent mistakes. They literally weren't paying to play. They were just making contributions in their personal capacities. Cost them big contracts.
So here's a map that provides kind of a snapshot of states that either have no pay-to-play law at all, have a pay-to-play law that is only a reporting regime, and those that have pay-to-play laws that impose either a restriction or a prohibition on giving.
One note on the general pay-to-play laws through the green states there. Some of those states may have particular industries. Like Louisiana, for example, has a restriction on contributions by the gaming industry. We didn't put those in there because we wanted to make this sort of general applicability. But if you're in particular industries like gaming, lottery, public utilities, those kind of industries, you want to double check to make sure there's not a separate set of rules that may apply there.
That may also apply to the service provider to companies in those industries as well then, is that right?
So, well, yeah, if you're generally the people who would have state contracts in those areas would be regulated by the state or licensed directly by the state in particular industries.
These laws unfortunately, they're always reactive. They're usually precipitated by some scandal. They're written to cover something that just happened in the state frequently without giving a whole lot of thought to how they might apply to other size businesses, to other kinds of businesses. And so a lot of the advice that we provide and the challenge for compliance is really to understand how laws that really weren't written sometimes with anything but a particular scandal in mind apply to broader industries. What's interesting about this chart and juxtaposed with this short list we have here is that you'll notice that there are a number of states where there is no state pay-to-play law, but there are municipal pay-to-play laws. And so, for instance, Texas doesn't have a statewide pay-to-play law, but you see San Antonio and Houston listed here as jurisdictions that have pay-to-play laws. Likewise, Colorado doesn't have a pay-to-play law, but Denver does. And so that means that if you're making contributions or you're doing business with a municipality or a county, you've got to check two things. One, whether there's a state law that may restrict contributions or require disclosure, but also whether the municipality has its own pay-to-play law that restricts contributions to officials or candidates in that particular jurisdiction. This is by no means a full list, but it gives you a flavor for just how many of these laws are out there. And you see New Jersey there, which is sort of the mother of all pay-to-play law states, where there are literally dozens of municipalities that have adopted their own pay-to-play laws that can often provide the same kind of severe remedies as the state laws do.
And so if you're a financial services institution that provides bond work or investment advisor work, in, say, to the city of Philadelphia, you've got the Philadelphia pay-to-play rule to deal with. There's a Pennsylvania reporting pay-to-play rule, and then the SEC or the MSRB rule to deal with. So that's a good example of the multiple levels of regulation, all because of that local work that you might be doing.
Yeah, I mean, we can't emphasize enough as we sort of leave pay-to-play that it's really important that you do a risk assessment, and that risk assessment needs to be based on where you do business and where your employees live, where you have contracts, how large are those contracts, how much of a part of your business model are interactions with the government, and how many people within the company are covered by the pay-to-play law, and then tailor a compliance program that makes sense for your business and for your business model. We've rarely found that one size fits all here, given the tremendous variation in the way businesses are structured and the way these laws are likely to apply to them.
So that covers our tour of the pay-to-play laws. And now we're going to talk about political action committees and sort of go over what PACs are and how they operate so that you can get a sense of how you can participate in the process. So a political action committee is basically a separate segregated fund that contains no corporate money in the account that is funded with voluntary contributions from individuals, so that are up to $5,000 per year from U.S. citizens or permanent residents. And then you use those individual contributions to make to the PAC to make contributions to candidates. For a multi-candidate PAC, that's up to $5,000 per election to those candidates. So again, it's the kind of shorthand, the PAC or a separate segregated fund or a political committee are the terms that might apply. There are federal PACs and there are also state PACs. We're going to focus our discussion really on the federal PACs today, but know that under different state laws you can also create political action committees. And a couple of sort of things to start with on sort of the myths of PACs. People will always say, what you just have this PAC, you're buying influence. And the answer to that is, well, there are PACs on all sides of an issue. And in Senate races that can cost $10 million, $5,000 contribution from one PAC is not a very large drop in the bucket. So you've got people contributing on all sides of an issue. It's not as if it's a one-for-one where you're going to make a contribution and get something done. People often say, PAC's dark money, it's very secretive. Actually, PACs, as we'll talk about, are very highly transparent. They're disclosed to the Federal Election Commission, so you know who's giving and how much they're giving to different candidates. Now, PACs do often provide an opportunity to interact with lawmakers, and that's by going to fundraisers with a PAC contribution. Companies have an opportunity to meet with members of Congress in an environment that's a little bit different than when they're sort of trying to get in to see them in the official office. So that's one of the advantages to having a PAC. PACs are designed to help to elect and retain members who understand and support the sponsoring organization, so they don't necessarily influence the outcome, what they do is they help to elect people who you think are sort of already predisposed or would likely be to support your positions. Connected PACs are usually nonpartisan. They're not formed to advance anyone's personal political agenda. We've, have a lot of times where people will say, hey, I don't want to give to the corporate PAC because you support candidates that I don't like. And generally, what I say is tell people, look, this is the company. We have to do this through individual contributions, but the PAC makes the decisions based on what's best for the company, not for any individual agenda. People are on, candidates are involved in a lot of different issues. The PAC is supporting a candidate for a particular set of issues that relate to the company. And the final point to make is that PAC contributions don't equal corporate contributions. As we said before, companies at the federal level may not make contributions directly to candidates. PAC contributions aren't using corporate money. They're using individual money that's voluntarily given by certain executives. So sort of the PAC basics. Contributions to PACs have to be voluntary. So you can't coerce an employee. You can't require an employee to give. You can't reimburse that employee for a contribution to the PAC. You can't condition their job performance on giving to the PAC. Contribution limits, $5,000 per year per person to the PAC, and then PACs can give $5,000 per election to candidates. One of the nice things about a political action committee that a company sponsors is that the company is allowed to pay the administrative and support costs of the PAC, the fundraising costs. So if you're going in a mailing to solicit contributions, or you've got staff time to raise money, that's all money that can be spent with corporate funds. You don't have to use your PAC funds to pay for those kind of things. The key is, though, that if you're a connected PAC, although you can accept contributions from any U.S. citizen or permanent resident, you may only solicit contributions from what's called the restricted class. And this is an important concept in campaign finance law. The restricted class for a corporation has a couple of different buckets. It includes salaried employees with policymaking or managerial responsibilities. It includes members of the recognized profession, so engineers, lawyers, doctors, accountants. It includes any stockholders of the company. Now, it's pretty rare that a company sends a solicitation out to all of its shareholders, but if you have employees who may not otherwise be in this restricted class, it allows you to because of their job position, if you know they're shareholders, then you're allowed to solicit them. The board of directors is included either if they are shareholders or, as most directors of companies are paid a stipend. As long as they're paid or are a shareholder, they're within the restricted class. And then it also includes the family members of all of these individuals. So if you have senior executives who are solicited for PAC contribution, you can also solicit the family members of those senior executives for PAC contributions. But what you're not allowed to do is solicit hourly employees or those employees who don't have policymaking or managerial responsibilities within the company. So now we'll talk a little bit about how you make those solicitations and how you actually raise money into the PAC.
Well, here's an example of a disclaimer that is the FEC requires on any communication with the restricted class that encourages contributions. And we generally advise that our clients to err on the side of safety, and whether you've got a explicit request for contributions or you're simply applauding people for having made contributions. The FEC, Federal Election Commission, takes a very broad view of what constitutes a solicitation, and it's important on any kind of communication that you have this disclaimer. You'll see this in different forms. Sometimes it appears as statements that someone agrees to and then signs, but this information needs to be on any PAC solicitation.
And if you're doing any oral solicitation, whether you're doing meetings or phone calls or visiting offices, we always recommend having a contribution form with this disclaimer on it so that it's clear that an employee can always be, an employee ever raises an issue, so yes, but we gave them this disclaimer and they had it whenever we communicated with them.
Right, a good idea to use even in small meetings. And that segues nicely to the next slide, which is, again, we can't emphasize enough the importance of avoiding coercion. There's always a risk if you've got a one-on-one meeting with a direct report that communication is going to be understood differently by the individual making the PAC contribution and then the individual soliciting and the individual who's being asked to make the PAC contribution, often based on sensitivity or prior history. So we generally recommend that you not raise money for the PAC one-on-one with direct reports. Group meetings are much better. And by the way, to Ron's point earlier about the things the corporation can pay for in the way of administrative expenses, if you want to have a breakfast to roll out the PAC, to help explain how the PAC's going to work and you're going to serve food, that's yet another thing that the corporation can pay for and you don't need to take money for out of PAC funds. No threats, no harassment, no promise of benefits. Follow-up is essential, but again, you want to draw a line there and not ask so often that it begins to feel to people that they have no choice. And again, the last point is always good to give the employees, have something in writing to hand the employees in connection with any oral solicitation that has the legal disclaimer on it.
One of the things that I've seen where companies will set sort of participation targets for the PAC, and sometimes they'll say, we're planning on 100% participation. And I usually suggest that you not set your target at 100% participation because it's really hard to get there on a voluntary basis, and to recognize that some people may not want to contribute. So set that number. You can set it high if you're a high achieving organization, but I wouldn't do 100% because then there's one more piece of evidence if someone were to complain about being coerced that it was company policy that forced people to make PAC contributions.
We often are asked whether it's permissible to suggest giving levels, and in fact it is, and often can be a very effective form of fundraising, and so it's fine if you want to suggest that VPs, executive VPs, directors all contribute at a certain amount. Again, that's strictly a suggestion, can't be anything that's imposed, and in fact there's additional language that has to appear in the disclaimer if you're making suggestions or guidelines in regard to contributions. And many of our clients will put that language as a matter of course in the disclaimer, so they don't need to worry about whether it's there when it needs to be. It's but something that can be very helpful in terms of raising money. And there you see the language there.
One of the benefits of the suggested giving amounts is that it's not so much to force people to give that limit because that's not permissible, but it really helps them to understand sort of what people, kind of what the going contribution rate is, so they don't wonder, gee, the person in the office next to me, did they make a similar contribution, or am I contributing way too much or way too little for sort of someone in my position. It can be really helpful to sort of help make sure everyone's kind of level set on where they are on their giving.
So you're permitted under FEC rules to raise money for the PAC through payroll deduction, and in fact trade associations can, if they comply with various rules, have their corporate members raise money for the trade association PAC through direct deposit or payroll deduction. It's a much more efficient way of collecting contributions, and one of the primary advantages is that it remains in effect until it's revoked. And so if all you do is ask for a check, even if you get fairly generous contribution checks, you spend that money, you've got to go back to the well again and convince people that it's in their interest, in the company's interest, to make contributions. With payroll deduction, it comes out until there's an express revocation, and it's much less painful way for most people to contribute at fairly high levels to the PAC. It's also permissible as a fundraising mechanism to use incentives like trinkets or prizes, dinners, receptions with senior leaders, senior members of the Hill, for example, or to even match charitable contributions that are made by the individual, to match that person's PAC contribution with a charitable contribution made to a nonprofit. One of the odder and trickier rules in fundraising when there's some sort of prize being offered is what is loosely referred to as the one-third rule. The one-third rule is there to prevent corporations from essentially recycling treasury funds through individuals and back into the PAC. And so what the rule says is if you're going to offer a prize, the prize can't be any more than one-third the value of the contributions raised. So if you're going to offer an iPad, you're going to have a drawing for an iPad for everyone who contributes to the PAC. Perfectly appropriate to do it, but if the iPad valued at $1,000, then you need to raise at least $3,000 through that fundraiser. And if you don't, if you raise less than that, then the PAC is required to reimburse the corporation for the difference. It's important and sometimes tricky too to define the universe of contributions. We typically will say to our clients that if you're offering some sort of a prize like an iPad in connection with a fundraising drive, that you identify or establish some limits and define what the drive is. It's going to be through these dates. It's going to be on this particular day or targeted to this particular group, so that you can look at the amount raised and make sure that you're in compliance with this 1/3 rule. And there you see some examples there. Again, the prizes that are awarded that can be offered, the trinkets, the charitable matches can be paid for by the connected organization, whether that's a corporation, by a trade association. And you see here over and over again, one of the attractions of having a PAC is, and one of the great selling points when you're soliciting for the PAC is either everything or virtually every dollar raised is used to actually make contributions to candidates, because any of the expenses that are involved in subsidizing the PAC, running the PAC, encouraging participation can normally be paid for out of the connected organization.
One of the other ways that we found a lot of people are very successful in raising money for their PAC is through the Charitable Match program, meaning that if you make a contribution to the PAC, then the company, again from its treasury funds, makes a contribution to a nonprofit, to a charitable organization, a 501c3. The keys are that the individual who contributes to the PAC may not receive sort of any token gifts from the charity. So if you designate the public television station as the recipient, you can't get the DVD set that comes with that contribution. The individual who makes the contribution to the PAC may not get a tax deduction for the contribution that the company makes. And the IRS just recently ruled that the company may not take a tax deduction for that contribution either. So if an employee contributes $1,000 to the PAC, the company contributes $1,000 to a charity, that's a non-deductible expense for the company. It's not a charitable donation, and it's also not a business expense, according to the IRS. You can limit this to a particular list of charities, or it can be open to any 501c3. If it's open to any, you need to make sure you've got sort of a system to verify who's an actual 501c3 that you're giving to. The FEC recently had a case with a large employer where they were doing 2-for-1 matches to their related foundation. And the FEC said that was okay. It could be a related foundation. It didn't have to be any sort of public charity outside of that. And in that case, it was a 2-for-1 match. So it was, you give $1,000 to the PAC, the company made a $2,000 contribution to the charity. In the past, the FEC had approved up to a 1-for-1, but now in sort of this enforcement context, it's a 2-for-1. So if you want to make a 2-for-1 contribution, that would be permissible at this point in time. I mentioned before that PACs are one of the most transparent organizations involved in the political process. Regular reports have to be filed with the Federal Election Commission. They're available online. They're filed electronically. Anyone who contributes more than $200 in a calendar year is disclosed on those reports by name, the address, the occupation, and the employer. One question we get a lot of times is, do we have to put people's home addresses on there, or can we use the company address? And the FEC rules aren't clear on that point. They don't make a distinction, so it's fine if for sort of privacy reasons you want to use the business address as opposed to the home address. There's a reporting schedule. It varies by election year or non-election year. Many PACs, particularly larger PACs, will decide to just report on a monthly basis all the time because you're reconciling on a monthly basis, and you're making sure that your FEC report matches your bank account, your bank statement. Although on non-election years, you are allowed to report on a semi-annual basis. So some PACs decide they're going to file just in July and then the following January. So there's a lot of options on when to file those reports. There are also record-keeping requirements under the Federal Election Campaign Act. Records have to be retained for 3 years after the date that the report is filed. So things like receipts, approval of all disbursements, signed prior approvals, all those kind of things have to be maintained. You can maintain them electronically. They don't have to be kept in hard copy form, but you want to make sure that you have all of those records. Then our last point on political action committees relates to sort of using the federal PAC in the states. And so in this chart here sort of gives a breakdown of where in the green states it's very easy to use the federal PAC to contribute to state candidates. So if you wanted to give to a candidate for governor or for state house, you can do so in these green states with very few reporting requirements. Maybe you have to file an initial form with the state agency to say we're going to use our federal PAC there, but very little else has to be done. The yellow states are a little more complicated. There's periodic reporting that has to be done, either filing the FEC reports sort of with the state agency, or in some states you have to file using the state forms, but there's some ongoing reporting requirements required. And then there are a few states that make it very difficult or impossible to use the federal PAC at the state level because they impose requirements that you have an in-state treasurer or an in-state bank account, or don't allow the company to pay the support costs of a PAC, and so it's impossible to use the federal PAC there. So you may need, if you're involved in those states, to create a state PAC to make contributions to state candidates if those states are important to you. So that's one of the advantages of the federal PAC, is that it really does give you pretty broad coverage in most states to make contributions. And if you overlay this with the corporate contribution chart that we showed earlier, you can really be politically involved in almost every state without having to form a state PAC. There's just a few states where it's kind of necessary to do. So we've now talked about political action committees, traditional political action committees. Now we're going to turn to talk about sort of the hot and exciting area that everyone talks about, although for corporate purposes is probably less important than you may think, and that is super PACs.
Well, life used to be a lot simpler for companies and even individuals who were thinking about making political contributions. For decades, your decision was really whether to give to the candidate or give to a PAC. Now there's an array of options that include 501c organizations, sometimes LLCs, 527s, and super PACs. We're not going to talk about all those options that you have today or you might receive solicitations for, except for super PACs, which seem to be growing the fastest and attracting probably more media attention than any others. Before we talk about what they are, it's important to go back to a concept we introduced at the beginning of the webinar, which is this distinction the Federal Election Commission makes between contributions on the one hand and expenditures on the other. It's an important distinction because contributions are often subject to limits and prohibitions, while expenditures, namely independent expenditures, may be made by organizations that can accept unlimited funds from individuals and even from prohibited sources like corporations. The difference in practical terms means a contribution is money that you give to a candidate or some service you provide that has value to the candidate that has to be reported and that is subject to limits and that can't be provided by a corporation. And expenditures are things that are done that may benefit a candidate or oppose a candidate but are done without coordinating with that candidate. The Citizens United case that Ron touched on earlier established that corporations may make independent expenditures. And prior to that, there was a ban on corporations making not only contributions but also making independent expenditure side. The Supreme Court said that if a corporation is spending money in support or opposition to a candidate and it's not coordinating that activity with the candidate or with the campaign, then there isn't any reason to limit that activity. And what grew out of that decision were a couple of District of Columbia Circuit Court decisions that expanded the ruling to say that organizations could pool funds from corporations to make independent expenditures, and indeed individuals could contribute unlimited amounts to these organizations so long as all they did is make independent expenditures. And out of all of this, the so-called super PAC was born. As Ron pointed out, we've seen relatively few corporations, comparatively few corporations, particularly few public companies interested in the space making contributions like this for obvious reasons. They don't want to antagonize their customers or their shareholders or both. But individuals, corporate executives, CEOs, and others have fueled the growth of super PACs to the point where they, in some elections, are much more significant players than the candidates and the campaigns themselves. So who can make independent expenditures? Again, any entity can make an independent expenditure so long as, the expenditure is truly independent and not coordinated with the candidate, and that can include nonprofit organizations that aren't regularly reporting to the Federal Election Commission, so-called social welfare organizations, like activist organizations that are usually attempting to influence legislation but can be involved in politics to a limited extent, trade associations. Again, the key for these 501c groups you see listed there is that the independent expenditures must be less than half of the organization's overall activities. It can't be its primary purpose. And then there are these super PACs, which the FEC still likes to refer to as independent expenditure only committees, because the term super PAC doesn't actually exist anywhere in the law, but that's what they are. They're committees that are registered and reporting, fully transparent with either a state or with the Federal Election Commission, and have committed that they will not either make direct monetary contributions to campaigns or talk with the campaign about the expenditures that they make. So when super PACs first emerged in the wake of the Citizens United decision in 2010, they were mostly limited to producing and airing advertisements on TV and radio. But in the last couple of elections, we've seen super PACs move into other areas that are, again, equally appropriate as running advertisements, so long as they're done independently of the candidate. And that can include producing mail or online ads, helping stimulate a ground game, getting out the vote, registering voters, even funding opposition research. There's a significant online organization that has been working to support Secretary Clinton's election, spending lots and lots of money, and it's primarily focused in this latter area of opposition research.
So one of the things, as we mentioned, is that super PACs tend to have fewer corporate donors, and that's really because, for a couple of reasons. As I said, one, there's the PR angle, that people dislike having their customers and shareholders may get upset about it. And so a number of companies have policies against funding super PACs. In particular, there's been an effort by some of the good government groups and shareholder organizations to force big companies, publicly traded companies, to have policies against giving to super PACs, and also to have policies about disclosing their corporate political activity beyond their Federal Election Commission reports. So what you're really seeing is at the super PAC level that because of these policies and because of the shareholder efforts, relatively few companies being involved in super PACs, but the executives themselves being involved. And there's even sort of some of these shareholder groups are now trying to push to limits on the role of the companies in lobbying and making sure they disclose their lobbying efforts. So it's important as we talk about all these different campaign activities and political activities, and we're going to kind of get into some specific examples in the next section on some how to be involved. To keep in mind that what we're talking about are the laws that apply. Your company may have other policies and procedures and disclosure obligations that it has adopted that you've got to be careful of and make sure that you're complying with those from an internal compliance standpoint as well.
So our last section, we want to talk about some of these principles in action in practical kinds of situations where they arise or are likely to arise in the months between now and the November election. The first one we want to talk about are the conventions that are coming up in July in Philadelphia for the Democrats and in Cleveland for the Republicans. And you may hear, if you haven't already, you may be asked if you or your company is willing to help support the convention, particularly if you do business or you're located in one of the states, either Ohio or Pennsylvania, where the conventions are being held. And there are options available for participating. There are new accounts that the national parties, the Democratic National Committee, the Republican National Committee, are allowed to have this for this election cycle for the very first time, where they are able to raise funds dedicated to help defray the costs of the convention. But like contributions made to the parties, the candidates, or the PACs, corporations may not contribute to those convention funds. Only PACs can contribute, or individuals. But the host cities, Philadelphia and Cleveland, are permitted under the law to form so-called host committees, which are nonprofit 501c3 organizations that exist primarily to promote commerce in the city and the reputation of the city. They're also helping defray the costs of actually hosting the city, and to those accounts, the corporations are permitted to make contributions. Separately, if you're not in a position or inclined to make monetary contributions, many companies will sponsor events, receptions, cocktail parties, entertainment, dinners, all kinds of things during the convention and even in the period immediately preceding and after the convention to help promote the brand, to help mix and mingle with members. It's an unusual opportunity in that it brings together so many people, federal, state, and local decision makers, elected officials, and frankly movers in the political space. One of the things that we hear occasionally from clients who are thinking about sponsoring events or providing some kind of free giveaway to the host committee or to the parties is we understand that their conventions don't have to comply with the gift rules. And as the House and Senate Ethics Committee reaffirmed and guidance issued only a few weeks ago, these are not gift rule-free zones. The ethics rules apply at the conventions just like they apply anywhere else. And so if you're thinking about hosting a cocktail party or providing a giveaway, a swag, a gift bag, whatever it might be, needs to be permissible under the gift rules. If you're going to host a dinner of some kind and invite, let's say, the Colorado delegation to your event, very, very important to look not just at what the House and Senate gift rules are, but what are the gift rules that apply to the invited individuals, to the state legislators in Colorado, and to executive officials in Colorado. There are particular restrictions on events honoring members, although, as you might expect, all kinds of exceptions, for example, that allow you to host events that honor a caucus or honor a delegation. As with all of these kinds of things we're going to be talking about in this section, planning can help, an ounce of prevention can serve as a pound of cure. Anytime you have a government official or candidate for office visiting the company, meeting with executives or employees, touring a site, there are rules to take into account, both on the campaign finance side and the gift side, and the rules that apply are going to depend entirely on the nature of the event. So one type of event that is fairly common are visits from elected officials who appear purely in an official capacity. While they may be running for office, there's no fundraising that's going to be associated with their visit. You've pre-established that they're not going to be talking about the election in any way, their agenda, their hopes for the future if they're reelected, but they're there strictly to talk about something that they're doing in their official capacity that relates to the business. Those kinds of events have got to be scheduled through the official office of the elected official, not through the campaign office, and that individual can come and speak to all employees. The campaign finance rules, the rules that affect election activity, don't apply or restrict that visit, but gift rules, as with any government official, are going to have to be taken into account before the invitation is extended to ensure if you're offering food or other items that invited guests can accept them. Another type of event very common this time of year are so-called restricted class events. And these are events that apply whether you have a political action committee or not. And what FEC rules have done here is create a carve-out for the general ban on corporations doing things to facilitate contributions to a candidate. And what the FEC has said is this: if you are hosting an event on your premises and you are limiting your invitees to members who fall into the restricted class, again, these are policymakers, members of the recognized professions, paid members of your board, then you can invite someone who is running for office or is holding office to come to your offices. You can solicit contributions from the members of the restricted class who you are asking to attend. You can provide food and beverage in connection with the event, and even the candidate can come and speak about anything, and the candidate or the candidate's representatives can encourage attendees to support the candidate and to contribute. The big no-no in this area is not to actually collect or even touch the contribution checks. You want to have a pre-arrangement where the checks are sent directly to the candidate in some way that the candidate will know that the contribution stems from the event that you held on the corporate premises.
I'm sorry, if the contribution checks are going to be collected at the event, to make sure that someone from the campaign is there to collect them, so that it's not an employee of the company that's collecting the contribution checks.
One of the nice things about this event and sort of the benefit of limiting your audience to the restricted class is you as a company can say, we are going to invite one candidate who's running for Senate, but not invite the opponent. There's no obligation under the law for sort of equal time if your audience is limited to the restricted class. The PAC can also host events for candidates. If you have a PAC, the PAC would pay for food and beverage and could invite people not just in the restricted class, but others in the company, others outside the company, guests, vendors, others you might do business with. The payment by the PAC for food and beverage and for room rental, all is considered an in-kind contribution to the candidate. It has value to the candidate who you're raising funds for, and therefore can't exceed the $5,000 limit. You know, what we'll frequently see are these kinds of events hosted on business premises that are co-hosted by 3 or 4 senior executives. And so in that circumstance, each of the individuals would be subject to their own limit and might be able to expand the amount they could pay for the cost of the event. What you see very commonly with candidates for the House and Senate is the campaign says, you know what, we want everything in cash, we don't want in-kind contributions, we'll pay for the cost of the fundraiser and we'll report it that way and make a $5,000 contribution to us in cash.
One of the things, if you're hosting the event sort of in a company boardroom or something like that, is to make sure you come up with the appropriate room rental charge. That you might not have a commercial value for that, but you come up with something that's reasonable, so the campaign can pay for it, so there's not a question of you providing an in-kind contribution. If you're hosting it in a restaurant, the campaign can just pay for it. A number of companies have gotten in trouble for hosting these kind of events and paying for it out of corporate money, paying for the dinner, paying for the food, and so that's where you do have to be very careful. A lot of the FEC enforcement cases for events could very easily have been structured in a way that would comply with the rules, but the companies didn't pay attention and understand what they had to do, either limit to the restricted class or have the campaign pay for some of the costs. Very easy to make things compliant, but you just have to make sure you're planning it ahead of time and and make sure that you've got the right bucket of activity that you're putting together.
We don't have a slide here on the corporate meet and greets for all employees, which is also something the FEC permits, but under much stricter rules. The company officials are not permitted to encourage all the attendees to make political contributions. The opportunity has to be available to all candidates for the same office. But again, there are rules. If you follow them, you can invite someone to come in, visit the company, meet with all the employees. You just want to make sure you can check the right boxes.
And just a reminder for folks attending today to please send any questions you might have in, and we will also be providing the CLE code at the end of today's session.
So we've talked a lot about making contributions to candidates. This is sort of the checklist if you're thinking to make sure that you've got sort of the compliance piece in place. And so if you're going to make a contribution to a candidate from the PAC or from the corporation, if it's going to be permissible, first of all, kind of the checklist is think about whether the candidate is a state or federal candidate. Then think about whether any of the pay-to-play rules apply. If it's a state candidate, determine whether you're going to make a corporate contribution or make a PAC contribution. And if it's a PAC to a state candidate, then make sure you know whether their reporting obligations apply. So there's kind of a thought process for each and every contribution that you make for any of the events that you're going to make to do fundraising. Make sure you've thought about all the different rules that apply so that you understand what the issues are and that you're complying with all the different things we've talked about today. In terms of the pay-to-play compliance, make sure that you've thought about the scope of your contracts, that you understand the officials that are covered, the covered officials that are involved there. Because there may be state government contracts that you have where there's not an official who has appointed anyone to the board or is subject to the rule. Other states it may be. Make sure you understand the scope of the employees covered by your pay-to-play rules, and then develop your compliance plan. So in some states where there's very rigorous rules, you're going to need a pre-clearance process so that every employee who is subject to the rule has to say, I'd like to make this contribution to candidate X. Is that permissible? Then you can say yes or no, or you can maintain a record of it for reporting requirements. Other times you might say, we'll let employees make contributions in these states, but in other states they've got to ask for permission, and you define exactly which employees they are. So it's very important to make sure you've got that plan in place, that you're determining whether the contributions that you're making are subject to the pay-to-play rules. But if you're making a PAC contribution, again, to make sure you've got the right control group on that PAC to make sure it's not employees that are subject to the pay-to-play rules. These are all different pieces that come together when you're designing a compliance plan to make sure that you've got everything under control and that you're not violating one rule or another that you weren't expecting to. So that's our tour of the political law implications for financial services institutions. If we have any questions, we're happy to answer those.
Ron, what type of enforcement mechanisms are in place? So obviously there's proactive reporting requirements, but if somebody's not reporting, how is it that a government agency, whether it's on state or local or federal level, finds out about an issue?
Sure. So at the federal level, it's a complaint-driven process. So you'll find an opponent may learn about a fundraiser that's held in a company or something that's done impermissibly, and they file a complaint with the Federal Election Commission. The Federal Election Commission then investigates. Sometimes, if it's a more serious offense, if an opponent learns that there's a reimbursement of contributions, then they'll report that directly to the Department of Justice, and there are criminal penalties associated with it. Disgruntled employees are a large source of complaints. We've seen a couple of cases at the Federal Election Commission where the disgruntled employee didn't even file a complaint with the Federal Election Commission, but went to the press. And so then the press wrote a story about how this company was coercing political contributions and forcing their employees to make contributions. And then one of the good government groups saw the press article, filed a complaint with the Federal Election Commission based on the information that the press is reporting. State level, the same things can apply. There may be state attorneys general who enforce some of these rules, so people go file complaints there to the state ethics commissions. And then again, the media is a big one, where it may be that people talk to the media hears word of a fundraiser that's going on, and they raise questions about how it's being organized. And it's not only the criminal penalties or the civil penalties in this area that are important to keep in mind, but also the reputational harm. Because if you're working on a government relations program to interact with members of Congress or state officials, and suddenly you have a big story about how you're not complying with campaign finance rules, there may be an effort to give back contributions, sort of make that organization sort of a pariah within the regulated community. And so it can really, those PR effects can really be almost as serious as the legal consequences.
Right, you've gone from trying to impact a particular outcome in a campaign or with a policy objective, and you perhaps landed yourself right in the middle of a government investigation.
Exactly.
Remember, too, that the recipients of contributions, candidates and super PACs, are filing reports with the Federal Election Commission or with the states, and that's a fertile source of complaints. So if someone notices that lots of employees from a company are maxing out to a candidate, and these are people who have never made contributions in their lives, someone may well look at that report and say, I wonder if the company isn't reimbursing those contributions. There was a federal government contractor that made a contribution to a super PAC, which is a sort of unsettled area of the law. The Supreme Court has said that corporations can do it, but the FEC has taken the position, at least for the time being, that federal government contractors can't. So that led to legal and reputational harm. So the problem is going to rise in a lot of different ways.
On this concept of having events for employees and restricted events and folks that fall in particular categories, do companies typically start with the list of folks they want to invite and then work backwards, or are they looking at it from the standpoint of what they can do from a fundraising perspective?
I would say typically the companies that are politically active, they've determined who their restricted class is. So they've figured out that it's from the CEO down, vice presidents, managers, directors, whatever the right cutoff is, they know their restricted class, and then they often don't invite everyone in the restricted class. And typically, for a fundraiser, one of these restricted class events, it may be the CEO, the senior vice presidents, and a limited group of people that they really want to have in the room there that are going to make reasonably sized contributions to candidates.
Kind of one, sometimes the number of people who will fit comfortably around the table. But the virtue of limiting your invitees to that so-called restricted class is that companies can communicate with the restricted class about anything, including encouraging employees to make political contributions and to support candidates. And so a lot of the rules that apply, the restrictions, the traps that exist when you're communicating with rank-and-file employees, and particularly with people outside of the company, are all out the door when you're talking to that select group of senior executives. And so it really is a much safer space to operate if you're inviting someone in to visit the company.
Now, if a company today suddenly finds itself wanting to get involved in the political process, has not historically been involved, best place to start would be developing that compliance plan and getting that in place, or should they identify what they want to do and then back into the compliance plan?
We always tell our clients new clients after we've talked to them for a little while, let's go back to what you're trying to accomplish. It's really all about goals. And it may be that a PAC would be an enormous benefit to your company. It may be that it would be of very little use. It may be that you want to have more opportunities to just invite officials onto the premises. It may be that you're in states where corporate contributions are permitted, and you don't need to worry about having a PAC. So it really is all about goals and objectives. And then I think to your point, Jonathan, you really want to think through how do we accomplish those goals while safely managing the risk. And there's almost always a way to accomplish what you're trying to achieve if you think about those things in advance.
Right, and these laws are changing so frequently, and the needs of companies are changing so frequently that a compliance plan cannot possibly take into account every scenario, particularly now when you're in the sort of the run-up to really what is the most active period in American politics.
It is almost a given that the campaign finance and gift laws, particularly at the state and local level, are going to churn probably every 5 years, or about a third of the states have new campaign finance laws. And these pay-to-play laws have really been springing up like weeds.
Yeah, you're right. You can't have a compliance plan that covers everything. You want to make sure there's a review process in place so that someone who is in the know, that understands the rules, can look at them. At the state and local level, you look to last year's scandal, and the law has changed to cover that this year. And so states where you typically think of as sort of higher corruption states, or states with more political scandals, their laws change every 6 months. And kind of the quiet, easygoing states, their laws stay in place for a very long time.
Well, again, Ron and Larry, thank you. There's no doubt you'll both be busy between now and the election, perhaps even a little bit after. And no question, too, that this is also an ongoing process for companies in terms of compliance, whether or not there is an election, for the very reasons you've just described. So thank you to both of you, as well as also the folks on our support team that helped put this together, and our attendees today. Thanks for joining. And if you can't get enough about the CFPB, of course, please feel free to check out our website, www.venable.com, and there's materials and presentations on a variety of consumer financial services and financial services topics. Ron and Larry also have a blog, politicallawbriefing.com, very terrific resource. And then also next week on the 15th, there's going to be a webinar presentation by members of our CFPB team on the proposed arbitration ban. So for those interested in that topic, please feel free to sign up for that today, and there'll be email alerts going out at least one more time. And as promised, the materials from today's session will be sent out, as well as also information about the CLE certificate. So if anyone has any questions afterwards, please feel free to email Ron, Larry, or myself, and we will be providing the CLE code in just a moment. Have a great afternoon. Thank you.